recovery is priced in, because we really have not really seen a full-fledged recovery yet now. So I think the overall what we are seeing is a completely global rally right now, driven a lot by global liquidity, driven a lot, and this has all been well documented and well said on your show by a lot of guests. So I'm repeating a lot of the points here said, and not also driven by a lot of retail participation, not only in India but a lot in the world, and maybe a hope of a recovery, just not right now, but maybe a recovery that will come in 1 or 2 years from now. But certain points that I would like to mention is, and you have mentioned on certain points on the lockdown and stuff, but one factor I think which I think is important to mention, and again, just not in India, but got globally, I think one paradigm shift that has happened in the sentiment is, I think, the fear of now a second wave coming, or let me put it this way, that a globalized, synchronized lockdown that we saw from March to June, July. I think that fear completely the market is now factoring not to come back of a globalized lockdown or the economy is completely shutting down. So I think that is what is reviving the rally. And if we do see that, and even if the cases continue to rise, I think what is important to see is that if that does not come through, I think the legs of the rally is still there. But again, it's difficult to say that when there is euphoria, the market can really go up. And I remember having this conversation with you in March, and those are the days when the Dow used to hit down circuit every day, and we used to think, where is the bottom?
Yeah, things change very quickly in a liquidity-fueled market, don't they, Ayon? Ayon, you've lost the jacket and the tie today. It's the Friday look that you're sporting. I want to talk to you about, one wall of worry, which till now, very happily, the market has ignored. Let me bring in Lata, because she'll explain this to us the best. What we got after market hours on Friday was the RBI's financial stability report, where we have the first official estimate of the extent of rise in bad loans that will play out by the time this year ends. Lata, not looking like a pretty picture?
Yes, it is a little disturbing. The baseline scenario that the Reserve Bank looks at is a 4 percentage point increase in NPAs. It was 8.5% as of March 31st, 2020. They expect it to rise in 1 year to March 2021 to 12.5%. But of course, the gorier picture is for the public sector banks, where even the March 31st number was 11.3%, and that is expected to rise to 15.2%. This is the baseline scenario. Private banks are better placed. From 4.2%, they go to 7.3%. And capital generally for the entire sector, the equity capital, what you call CET, Common Equity Tier 1 capital, that is expected to come down from 11.7 to 10.7. But this is the average. Some people will be out of business, and that's what they're pointing out. In a severely stressed scenario, the gross NPA for the entire system could rise to 14.7, almost 15%, and 5 banks will be out of capital. So they don't tell us whether they will be public or private sector, but that's the problem before the government. As you will see, already the credit offtake is coming down. So according to the financial stability report, the biggest risk is growth, and the second biggest risk is fiscal housekeeping. At such a situation, the government may be called upon to capitalize banks. That's the broad picture they're pointing out with respect to the financial sector. But the governor also says a little cheekily in his forward that he is presenting this report at a time when the financial markets bear no connection, bear no reflection of the real economy. So chances are that this report also will leave the market unruffled. Ayon would know better.
That is exactly the question that I had for Ayon. Ayon, come on, here it is in black and white. The RBI is giving you projections. Will the market ignore this as well? A 400 basis points probable rise in gross NPAs.
Well, actually, if you see the market, I think the sector that has not really joined the party in a big way is the financials. So, it's a little bit harsh to say that the markets has completely ignored this risk in the financial sector. Of course, in the last few weeks or so, and that is probably buoyed by better than expected numbers on the moratorium side and some results on. Of course, this has come from some of the marquee names. But financials is one sector that is really not, both on the NBFC side and from the financial companies, bank side, which has not really, as I said, joined the party. That they have not really reclimbed the lows of March. But we've also, what we have seen as, and on the point of the capital adequacy that Lata was mentioning, and we have already seen that some banks have expressed their desire to raise capital, and some of them have taken approvals for the same. So we're doing that. But I think for the financial sector, I think among the institutional investors, I think even now the confidence to invest in the financial sector is still not there, and I think they will be, and the NPL issue is something that they are looking at. If you leave aside the top one or two names in the private sector and maybe the top name in the NBFC sector, I don't think so. A broad-based investment thesis is still there to invest in those names. And I think what the market will be looking very closely is that whether the moratorium period will be extended, whether one-time restructuring will be given or not. So these are the things that we'll be looking at it, and looking at this RBI report that has come up. Maybe these questions will be asked even more right now going forward.
Ayon, let me put you on